Most people sign a 30-year mortgage and accept it like a life sentence. Same house, same payment, 3 decades. But here's the uncomfortable part. The bank doesn't expect you to pay faster, because the longer you stay, the more you pay. So here's the real question. Is a 30-year loan actually a plan, or just the default path most people never question? A mortgage looks simple on the surface. 1 EMI, 1 schedule, 1 end date. But underneath, the system is not neutral. In the early years, most of your payment goes toward interest. Not the house, not your ownership, just the cost of time. The problem is, many people think they are building equity steadily from day one. If you're paying every month, why does your loan balance barely drop in the first few years? Because interest is front-loaded. The system prioritizes interest first, principal later, which means time becomes the most expensive part of your loan. Now here's where it gets interesting. 2 people can take the same loan, and one of them finishes in 30 years, while the other quietly exits in 10-15. Most borrowers follow the EMI schedule exactly as given, no changes, no adjustments. But that schedule is designed for predictability, not efficiency. What if the loan is not fixed, but flexible based on how you repay it? A mortgage is recalculated every month on the remaining balance. Reduce the balance early, and future interest drops automatically. Which means small changes early on can create large time savings later. Let's slow this down for a moment, because this is where the hidden math sits. Interest is calculated monthly on the outstanding loan amount. At the start, the balance is high, so interest is high. And if the balance reduces slowly, interest keeps accumulating quietly in the background. What happens if you reduce that balance faster than scheduled? Every extra payment goes directly toward principal, which reduces the base on which interest is calculated. This creates a chain reaction: lower balance, lower interest, faster repayment, shorter loan duration. But here's the part most people underestimate. They assume you need to double your EMI to cut the loan tenure significantly. That sounds stressful, unrealistic, risky, so they do nothing. What if reducing a 30-year loan doesn't require extreme changes, but consistent small adjustments? The strategy is not about pressure, it's about timing and consistency. Adding a little extra to your EMI when income increases, making 1 extra EMI payment per year, using bonuses or surplus cash for prepayment. Done early, these have a disproportionate impact. Because early years carry the highest interest weight. Now zoom out for a second. A 30-year mortgage often results in paying nearly double the original loan amount over time. Not because the rate is extreme, but because time multiplies the cost. Are you paying for the house? Or mostly paying for the time you borrowed the money? When you shorten the loan duration, you are not just finishing early. You are removing years of future interest payments, which means the real saving is not in the EMI, but in the total cost avoided over time. And here's the quiet trade-off. Aggressively prepaying without planning can create liquidity pressure. Paying off debt faster sounds good, but not if it leaves you financially exposed elsewhere. So how do you balance faster repayment without increasing financial risk? The approach is simple but disciplined. Maintain emergency funds. Avoid overcommitting monthly cash flow. Prepay only from surplus, not essentials. Because the goal is not speed at any cost. It is reducing unnecessary interest without creating new stress. So here's the final question. Is your mortgage timeline something you're actively shaping, or something you're simply following? Because the biggest cost in a loan is not always the interest rate, it's how long you stay inside the system. And sometimes, reducing that time changes everything. Subscribe Wealth Insure Lab for more updates. See you in the next video.